Jay, thanks for being with us in the Swiss Mining Institute. So, to begin with, can you start by introducing yourself and your company?
Well, thank you. Thanks for having me. I'm J.C. Sandoval. I'm the CFO of Andean Precious Metals. We're a gold and silver producing company in the United States and Bolivia.
It's quite unusual to have to operate in such different jurisdictions, right?
It is. I guess it's a little bit, of the history of the company. We started as a small single asset Bolivian company. When we acquired it, it was more of a distressed asset because it had less than 1 year of life of mine. Long story short, we were able to really extend the life of mine of our operations in Bolivia. Over the next few years, we built a lot of money, $100 million in cash with no debts or stream or royalties, and it allowed us to look for our first acquisition. And at the end, we decided to go for this gold producing mine in California. It's a fully permitted gold producing mine in California.
So to clarify things, the mine in Bolivia is called San Bartolome, right?
San Bartolome.
And in California, it's a Golden Queen, right?
Golden Queen, correct.
Which of those two assets would you consider your core assets, or maybe both actually?
It's interesting. It's a great question because right now we're more or less evenly split. We produce around 4.5 to 5 million ounces of silver in Bolivia. Most of it is silver. And in the US, around 50,000 ounces of gold. Most of it is gold. So, we are more or less evenly split, not only from a production standpoint, but revenues, resources, profitability. So both are important for the future of the company. Correct.
Okay. I was lucky, as I told you before the interview, to invest before in the start of the year. For Q3 of 2025, you delivered record productions and revenue. And how do you think this performance is sustainable in the future?
That's a great question. So yes, I think from you have to look at two things: your production and prices. I think we have on both of our operations, we should expect to see a very stable production profile, the levels that I told you about, and I think at least in the medium term, gold and silver prices are going to stay strong.
Sure.
So I think from that perspective, we should expect to see a solid end of the year and going forward.
Yeah, this part on price does not depend directly on you, but do you expect the all-in sustaining cost to remain flat or to increase a little bit?
No, I think my all-in sustaining cost, most of my capex has been destined to our operations in California. Over the last year and a half, we have invested close to $50 million into Golden Queen because before acquiring it, we knew we needed to invest, but that capex is actually, we believe it's going to start coming down. So my all-in sustaining cost should get closer to my operating cash cost. I mean, to give you an example, right now, my operating cash cost at Golden Queen, it's around $1,600, give or take, right?
Yes.
All-in sustaining cost goes up to $1,800 to $2,000. Why the difference? Because all this heavy capex that we've been doing over the last few months. But that's going to eventually come down, so my all-in sustaining cost should be getting closer to my operating cash cost.
At the beginning of the interview, you mentioned that the San Bartolome mine had a 1 year expectancy life, and you managed to increase life with deals with Comibol, right? And how much mine life, additional mine life, do you expect to have?
Yeah, because thanks for raising that, because in Bolivia we're very unique. Yeah, we bought that mine when it had 1 year of life of mine. What we did, we're thinking outside the box. What we started doing is blending our ore from our own deposit with third-party purchases. And you know, it's all about the location of where we are, right? This is a very rich mining district where they've been mining for many, many years. There are a lot of players. You have Comibol, as you said, which is the state-owned mining company. You have a lot of artisanal miners. You have cooperatives. You have other private and public groups. So what we started doing is buying more grade ore from those third parties, blending it with our own production, which it got to a point where after so many years of extending the life of mine, we realizing that we could get much better ore, better grades, better quality. We ultimately stopped mining from our own deposit, so everything that's coming to our plant right now is coming from third-party purchases.
Ah, okay. And if we go back to the Californian mine, the Golden Queen, it seems that you will be announcing new reserve on NI 43101 in Q1 2026.
When we acquired the company, one of the reasons why we acquired this company was the very strong exploration potential. We've had identified a couple of veins that hadn't been exploited or explored by the previous management. We started this exploration plan campaign last year. We've already made 3 announcements to the market, all showing very positive results. So we're very optimistic that sometime early next year, I would say, we will be able to present a new 43101 compliant technical report.
Early next year, okay.
Proving the extension of the life of mine, which is, I think it's one of our major catalysts for the company in the near term, right?
There have been stories about issues with this Golden Queen, legal issues or some other problems. No, can you tell us more about that?
No, if you're referring to California, for us, we're in Kern County, California, which is a mining-friendly district. Mm-hmm. We have an impeccable, great relationship with them. We have a great reputation in the state, so really no issues.
No issues. No. Okay. Now let's talk about the stock market. You've moved to the TSX, right?
Early this year we moved to
yes.
we were on the TSX Ventures and we moved to the TSX early this year.
You renewed your NCYB, and for those of our subscribers who are not familiar, it means you will be purchasing shares?
Well, we started that plan a few years ago when we knew we were so undervalued. We bought back over the last few years around 13 million shares. That's equivalent to almost like 10% of the company, a little less. We bought them back at a much lower price compared to where it is right now. So if at some point we were to bring those back to the market, it'd be a huge gain for our shareholders.
Will you need to raise additional money? Or more specifically, how do you balance between buybacks, growth, CapEx, because it is a very CapEx-intensive industry, and new equity?
Fortunately, we have a strong balance sheet. We announced just last week our third quarter numbers. Our cash and marketable securities increased from $87 million in Q2 to $121 million in Q3. That's cash and marketable securities. So we only have $36 million in bank debt. So we have, which can be repaid, with the cash we have. So we have a very strong balance sheet. We're cash flowing. We've just last quarter we were generating more than $10 million in free cash flow. So at this point in time, no, we don't need to raise equity. Never say never, because yes, we're actively
still you're in very intensive capex.
Yeah, I think the capex can be covered with our own operations and with the cash we have. But we'll see. I don't know if there's an acquisition going forward, something we might be raising.
I don't remember, to be honest, if you pay a dividend or if you plan to pay a dividend.
Great question. Right now we don't pay dividends. Why is that? Because we're a very unique company from the shareholders cap structure. Our founder, who is still the executive chairman of the board and CEO, he still owns more than 54% of the company. Eric's brought, a well-known Canadian investor.
Yes.
He owns another 15%. So between the two, they
In
own.
general, roughly from 1 out of 2 companies we hear about this guy.
Yeah, this guy is, he's been investing. And we have a great relationship with him. He's got 15% of the company.
15 you said?
15. So between the two, they own 70% of the company. I think that's a very strong statement to be able to say that the 2 largest shareholders are so vested, so committed into this company. They're not going to let this company down. So.
And those guys prefer buybacks than dividends?
No, so going into the dividends, I don't think right now it makes a lot of sense to start paying dividends, because for every dollar I pay, 70 cents just goes back to these 2 same guys. And they've been saying, just JC, keep it in the company. Let's keep investing in the company, right?
Makes sense.
And then another thing, when you start paying dividends, you need to be well diversified, right? Because if you start paying dividends, you don't stop, right?
Shareholders expect you to pay dividends all the time.
Pay dividends. So I don't think we're there.
Okay.
We're there yet.
If we're going to talk back about Bolivia, and if I'm not mistaken, there is an ongoing dispute with a silver elephant. How do you see that affecting the potential of the San Bartolome mine?
It's a litigation that we have. With all I can say right now, it's not material.
There is no.
For us, it's not material. There is a litigation ongoing, but it's for us, irrespective of the outcome, it's not material.
No financial risk involved.
No.
Okay.
No, it's not material.
Okay, going back to the fact that your company, Andean, is operating in 2 very different territories, the United States and Bolivia, with very different ESG environmental constraints. How do you manage that?
From an ESG perspective, we're very proud of what we do, especially in Bolivia. You know, we contribute a lot to the local communities. Our company, the city of Potosí, which is right next to the mine, 25% of the city's GDP depends on our company. And then you have the multiplier.
Oh, that's a lot,
effect.
yes.
That's a lot, and we're very proud of that. We contribute a lot to the community. 97% of our employees in Bolivia are Bolivians. So that's important for us. Obviously, in California, it's a bit different. But
you don't have the same obligations.
No, but in any case, we do contribute a lot. We want to give back some of what we get, right? So we're very proud of that.
Okay, good. Well, that's last questions. If we look ahead in the next 12 to 24 months, what are the key catalysts that could drive the price of the share higher?
Yeah, thank you.
And what are the the risks involved?
Yeah, I think there's 2 ways. One is we're going to keep growing organically, thanks to the expansion of the life of mine
San Bartolome?
Golden Queen, and in San Bart, securing more long-term contracts, so we'll keep growing organically. We have the potential to keep growing organically, and on the other hand, to grow inorganically. We are very well positioned. Like I said, we have a strong balance sheet. We can use our stock this time around.
You're looking at acquisition targets as I'm speaking?
Correct.
Okay.
We're looking, so there's still a long way to go for this company.
Okay. And one last question, which I didn't think about. What's the lifetime of your contract until when you can operate in Bolivia?
Oh, it's a great question, because like I said, we no longer mine from our own deposit. Right?
Yes,
so
true.
Everything comes from third-party purchases. But it's a good question, because let me explain very quickly. Say 40% of what goes into a plant is coming from
tailings.
Long-term contracts, which are set with a fixed price per ton. So you're exposed to the commodity price. But on the remaining 60%, we pay more spot purchases, and you pay the ore based on market prices. So you are less exposed. It's less in high price environments. It's less profitable, but it's less risky, because you always go for that operating margin, right? So if prices go up or down, you'll always be making money. So the combination of both those long-term contracts on their fixed prices, and then those spot purchases still make it a very profitable business, as we have demonstrated in the past, but less risky overall. And then on top of that, you have the U.S.
Yeah,
right?
good.
So it's a good combination.
Yes. Thank you very much for your time.
Thank you very much.